Recording in progress.
All right, good morning, everybody. I was reading through the 5 things you need to know email, which is provided by Bloomberg, and they continued to talk about the hawkish stance anticipated by the Fed next week. One of the data points that the Fed is going to reference next week is CPI. It is one of their preferred indicators, and we will be getting CPI data today. So not only will the Fed today be getting a data point that is going to be very important, I think the market is going to get a glimpse of what the future may hold for that November 2 rate hike. And they've been unwinding a 75 basis point rate hike, which we're going to be looking at here in a few minutes. And the market's not going to appreciate, I guess is a good way to say it, that they're wrong. They're not going to like it, right? It's going to cause us to flip over. I'm almost positive of it, which is why I named the title of this morning briefing the way that I did. So here is the 75 basis point rate hike probability. It's down to 83% now, and we went from a week ago having a 5% chance to having a 16% chance, and that's because they're unwinding the 75 and pricing in a 50. But it's all based on, I don't know, squishy feel-good metrics and nothing to do with data points. The Fed has in no way given the nod or the wink or had the talk of any kind that they're going to not get a 75 basis point rate hike next week. However, the CPI data today is going to go a long way towards reminding people of that. So it's likely to be a bit impactful. I've seen a lot of posts over the last few days that pointed out something that I thought was prescient. I like that word. In the last week, we've seen some of the biggest mega tech names just get gut punched, and the market is still standing. In fact, on the week, we're very likely going to be closing positive on the week. That's almost unheard of, right? The idea that you could see, Amazon take a 25% move, Facebook 25% move, just these horrible earnings and drastic moves to the downside, and we're having a green week? Nah. Okay. It's okay. So Bank of Japan left rates unchanged. That was not a surprise. They continue to leave rates unchanged. Every single analyst and trade guru that they talked to get their survey consensus, they all said it was going to remain unchanged because that's what they do. It's an experiment. And we're all kind of, watching it unfold. They've been saying for years that it's not viable, it won't work, and it will blow up, but so far, it's still working. We had a topping candle in the S&P 2 days ago, and we had a topping pattern candle in the Dow yesterday. And you add to that to the idea that the S&P broke below my level that says don't break below. But remember what I talked about the other day. This low is the one that is more valuable to us when we think about, we set a low and then we want a higher low and now we need a higher low. The idea that we came back inside my box, that's not good. It's definitely not good. But as long as we hold above 36.5, then we have the beginning of that trend that I was talking about, right? There's your higher high, there's your higher low. That's half of a full set. So we'd be looking for either this to be a low and price works its way back up, or that we get a print a little lower and that becomes the low, and then price works itself up. We are underneath the 4-period daily moving average. We're under the 50 again. We bounced off of the 200, or excuse me, the 10 yesterday. So we made contact with it last night, like a little bit of a springboard or a reset. It's not necessarily a bad thing for the market to come back and touch and test that 10. So we have CPI. And the pending home sales index. And really, I mean, that's a wrap for the day. That rig count, I don't hold any weight to that. I worked on those rigs for 20 years. And the number of active rigs normally isn't going to change more than, say, 4 or 5. Of course, there's always like a surprise element. We could see, something crazy like a whole company take their rigs offline or something. That would be a little unusual, but it's possible, right? And then, when they come out with the new flex rig systems, it's always possible that they have to, just like recalling a bunch of cars, they could recall a bunch of rigs all at once. But if you go back and watch the data points on rig count, it's nearly a flat line, right? With a very few minor pivots where it swings wildly in different directions. So no expectation of that being impactful. It seems like this is the first day in a while where we don't have Yellen talking, and she's been constant, non-stop, talking about the idea that treasuries need to be bought up and we should be activating some kind of Fed program to initiate a new treasury program, which would not be the first time in history that such a thing had been enacted. The framework is already in place. They would just have to start doing it, cutting loose the long end and rebuilding on the front end. But she's not speaking today, at least not yet. So, pretty obvious that we're in an inside day breakout. I guess it really depends on where you consider the end of the day at. Just like we talked about the other day when it comes to these really big candles, they are, in my eyes, a really big gap. And that gap needs to be filled. And it doesn't matter that you can see the candle there. Liquidity-wise, it's a gap. And it wouldn't surprise me if we managed to get all the way back up there and close that gap and then just dump. So that's going to be one of the things I'm looking for today. 38.20. Got a cog line at 38.11. If we manage to get back inside of what I consider to be yesterday's trading range, which would be above 38.20, then we'll focus on the Globex low, 38.34. Globex high, 38.67. And I mean, if we get that close to the high of the day, we're very likely going to go to the high of the day, 38.70 from yesterday. This is a whole lot of mess. This is what they call a broken chart, right? You can't really rely on any form of consistent technical analysis of, like consistent candle movement when your chart gets broken. And that's what a big candle like this does. On the other side of that, there is the discussion about measuring big candles. So for a continued downside move, you really want to measure that big candle. One thing to note with a big candle is the 50% line, the midpoint, and how we shouldn't normally go through that midpoint unless we're actually going to come back and retest the start of that candle, and we are through the midpoint. So I have an expectation of closing that, but we do have CPI on deck, so we might not get there in time, other than whiplash. This really big candle was Jackson Hole when Jerome Powell did the mic drop and said more pain is coming. And this big candle is CPI print. It was the day that we had that drastic, extreme, oh dang move. From where we closed the day before CPI to the lowest point on the day of CPI, we moved 4.6% that day. You see that topping candle that I was talking about 2 days ago? We had our topping candle. All right, so we got some downside projections, but the thing about a big candle like this is that you can map it both ways. So if we do happen to get back to the top of the candle and then begin continuing the move higher, you can actually map it out the other direction. Notice, however, that it lines up perfectly with our other pivots, which is kind of a good thing because it validates the pivots that we're using, right? If you can mark out a data point using one set of data, and then you can mark out that same data point using entirely different data, then it kind of confirms the data point that you're using, right? You're not so worried about multi-collinearity or the echo chamber. So our 50% mark lines up on the ADR half, almost spot on perfect. The 1236 lines up perfectly with the Globex low of yesterday, and 100% of that big candle lines up perfectly with the high of yesterday. Not voodoo, right? Just math. I love math. The 50% move to the downside almost lines up with the ADR half, and 100% of the move to the downside gives us nearly a midpoint between the full ADR. And we have an additional market maker move of $27, which is around 0.75% of a move. So, do some easy numbers. Take our ADR to 275, add 75, that'd be 3.5, and then just take 15 off of that, 335. So 3.35% is the expected move for today to the downside if we want to bring in the market maker move. Now the argument comes in, well, where do you start the math? Do you start it at the beginning of that big candle or at the end of that big candle? I'd say do both, just in case, right? So from the start of that candle, 3.35 really lines us up with our ADR marker. So that's cool. It just lines right back up again. Taking it from where the big candle close was at 4 o'clock. That gets us down nearly to 36.5, 3650. I'm going to overshoot enough just to get there, right? But if we were to backtrack it and get more specific, it would really be 3660. All right. Just kind of do the same thing. Instead of starting at the bottom of that candle to measure up, start at the top of that candle to measure up. $39.50. Now those are extremes, but today is likely to be extreme. So, it's not like I'm sitting here saying we're going to move that far. It's more of the idea that we could move that far and it wouldn't even be out of line, not even a little bit out of line. That would still not be back down to the bottom of the box, however. Right? We can see the bottom of the box is 3,600. But it will keep us above that pivot that I talked about that was so critical. Right? We really need to basically maintain above 36.5 if we're going to get our higher low. Interesting enough that the volume is not light today. I would have anticipated a much lighter volume as everybody would be waiting for the CPI, and that's not what we're seeing, which is a little odd. We have a 50% retracement, 38.27. It's another one to mark. All right, you can see we're in that shallow area that we were discussing the other day, and there really isn't anything down here. It's like an air pocket of risk, and any move to the upside is now going to have to contend with that 38.50 large volume shelf sitting there. And it's a considerable amount of resistance over our head, and there still is really no volume support until you get down around 3700, which is the point of control. So from 3850 to 3700 is just this real big air pocket of risk, and we're in it. We do have an untouched point of control now. It's a VPOC. $38.43, and this VPOC is now done because we went through it yesterday. The violence during the report was so extreme that we ripped right through it, never slowed down. But later, when price revisited the area, it was recognized at that point. It's kind of interesting, I guess, in the grand scheme of things, but it doesn't do us any good. We no longer need that. We take it off. And it is Friday, so we want to take a look at what the market makers are pricing in for the expected move of next week. So this is the size of our box this week. And that's the size of the box right now for next week. And you can see how much more volatility they have priced in. Which is kind of interesting, right? Because back here, they had a really big anticipated volatility. And then the very next week, it was smaller. And the very next week, it was smaller still. And now it's beginning to expand again. Keep in mind that anything that's using volatility as a measurement is broken right now. And they don't have a solution to the problem. The problem is the changes made to the SPX. So the SPX is the product that they use for experimenting and trying out new things. And the options market is constantly trying out new things. It's not something set in stone, right? It is like a living organism. It's constantly growing and changing and adapting. So for nearly a decade, nearly 10 years, we had 3 expirations a week in the SPX. That was SPY, the SPX, just S&P. And it lasted for a decade because they had to experiment. They had to study and find out if we bring in 3 expirations in a week, how much will it change things? And then they gave the market a lot of time to kind of prove how it would change things. And when they were finally convinced that it was going to be a positive, they opened that idea up and started doing it on other markets, right? Like the Russell, the NASDAQ. So it spread out into other ETFs. Soon, the word is, it's going to also start to spread out into equities like Apple and Microsoft and things like that. But at the same time that they made that change and started spreading it out into the NASDAQ and the Russell, they again changed the SPX. And the change that they brought in was an expiration every single day of the week. And the reason that they experiment is because they're just not sure of the ramifications of that. Like what's going to happen, positive and negative, if we bring in 5 expirations a week. One of the effects of this is it's changing volatility metrics. Volatility is based on options traded volume in the SPX. That's literally what it's like options volume. Now you can bring in fancy words and nerd speak and try to confuse people with fancy lingo, but at the end of the day, it's reading options volume in the SPX. And now the bulk of all of the volume in the SPX is in the front. It's not 30 days out, which is where VIX is read from. VIX uses 30-day options volume. But the bulk of all options volume right now is in the front. So VIX isn't getting a proper read because there's no activity there to read off of. Don't know what to do about it. One of the things that I was looking at this morning is the idea that the old volatility tool still exists. It's the if you were to look it up, it's called like the old formula. Oh, of course I don't have it sitting there, but it's basically using an S&P 100 instead of the S&P 500, and the math is basically the same. It's just where they get the data from is different. You can see how this one says VIX methodology, new methodology. There, maybe that's the one. Yeah. So this is one idea that I don't know if it's going to be viable or not, but that would be one direction that we could go, since the SPX is the S&P 500 and not the S&P 100. If we were to swap to a product that might not have the 5 expirations a week, because notice SPY also doesn't have 5, right? That we could get a volatility read that's a little more accurate because it's not being affected by the 5 expiration situation. I don't know. It's just a thought. I don't know what to do about the volatility, and I'm not the only one, right? There's people way smarter than me trying to figure this out right now. The point is, be very careful with VIX and any VIX related products, expected moves, earnings measurements, anything like that. 40% of the NASDAQ is down at least 0.5% this morning. It's pretty broad-based across the board. Only 20% of the S&P is down 0.5% this morning. And while there are a few names on there that are finance, it's not the bulk of what we see that's down. I do see quite a bit of chip names on there. Chevron and ExxonMobil both are doing really good this morning. And their charts look great. I mean, for like swing trade logic and things like that. At the end of the day, though, no matter how much we believe that energy is going to do good, or that, that we got this rotation through the sectors and all of that, at the end of the day, in a bear market, everything gets hit, right? So you can see energy doing good. You can see, say, crude maybe doing good, but companies are going to still get whacked. So I bring that up because someone was asking about energy for a long trade. As a company, these companies are still going to get hit. All right, so we're looking at the S&P 500. I've filtered it down, trying to narrow it as close as I can to make it an S&P 100. It's not spot on perfect, but it's closer. You can see a couple of those names that stand out. Apple and Meta in the green. It's the only two really out of the monsters of tech that are green. And we got a little bit of energy. An odd communications name, but it's not the only one. Mostly in the red though, right? And a little more flat than I would have anticipated. The flat is interesting. It's interesting because after all of the misses this week in earnings, the expectation was just a market destruction. And instead, we're so far looking to close green on the week. And that's largely due to what's happening in the yields and in the dollar. So it kind of timed nicely that Bank of Japan and Bank of China both are defending their currency, and kind of helped the market through this rough period. But when CPI comes out today and the market gets reminded that the Fed is still hawkish, I don't think there's anything left to save at that point. So I changed this now. We're looking at the NASDAQ 100. Apple and Meta stand out, obviously. Nothing else really does. Intel. I'm still holding shares in that as a long-term trade. Intel and Ford. If you're looking for a cheap EV name, but yet a name that has some legacy behind it, I mean, Ford is about as cheap as you can get and still have that legacy behind it, right? Like newer companies got to be worried because they're newer. And then, are they US based or not? NEO gets whacked with all the other China ADRs whenever China goes after its own companies. So, trying to go that direction isn't really comfortable. Tesla's too expensive if you're looking for a cheap company. Ford fits the bill. Just keep in mind, and I heard this data point from a number of fund managers this week that everything out there is really bad, which is why they're really bullish, right? Because if your time horizon is the next decade, this is premium buying environment. And you're going to be willing to hold when the market goes down lower and be buying more as it goes down lower if your time horizon is farther out than, say, the next 3 hours, 3 weeks, 3 months. And I think that's where a lot of the buying we see continues to come in at. I see biotech is making a little bit of a move. Um, Mish from Market Gauge, she's been calling for biotech to start like a basing pattern and begin moving higher. She was pretty adamant about that over the last 4 to 6 weeks. I've seen some people calling for a top in the dollar, as in the dollar is done, the run is over, um, this is going to be the end of it. I don't agree with that. I don't think it's done yet. It's hard to argue that it's bullish right now. I mean, that certainly doesn't look very bullish to me. But, in the last 6 weeks or so, there's been a lot of activity going on with Bank of Japan and everything else. So, I think that has a lot to do with it. It's deliberately being attacked right now, so it's down. It's not just like when a stock goes down. This is being attacked. I mean, there's no better word for it. All right, so we were talking about the VIX. We're still going to use it. You know, it's what we have, so we're going to use it. But just kind of approach with caution. I'm going to see if Thinkorswim has the old methodology, the old math VIX indicator, and if it does, then you know, I'll tell you guys what the symbol is when I find it. We might just start mapping and using that one. For right now, you know, this is what we have, is what we're going to use. VIX is still really low, which doesn't make any sense, so I wouldn't trust that as far as I could throw it. That thing is not going to be perhaps as accurate as, you know, the VIX futures, which does use a little different methodology, but this also still not showing much. Kind of consider it this way: volatility is cheap, and it might be worth buying some of it just because it's cheap. For no other reason than it's cheap. We need a hedge. Things aren't done, right? And that there's still a lot of pain likely on the horizon. The thing about using VIX for a hedge in the current market, where it's not spiking, it doesn't make these big drastic moves like it normally would, that it's kind of a sorry hedge, right? Considering. So to get any real value out of it, you can't really use much on spreads. No kind of complex, tricky stuff. You just got to go in and buy options at the money. And I say at the money, but at the money is not at the money. VIX options don't look at VIX candles, right? VIX options look at VIX futures. So unless you're in the very front, then it's looking at VIX candles. You start going farther out than the front, and you need to look at the volatility futures to see where at the money is. So January VIX options, go to the January VIX futures and see what at the money is. Now, having said that, there's always the talk about, well, can I just do something really cheap like a lottery? Like, you know, the world is burning, you know, February 2020 style market. What if we get into that kind of situation? Can I just protect myself against that? Yeah, those 40 calls don't look bad, right? It's about 35, 40 cents. You could work the order, you know, maybe get it around 40 cents. Those would kind of put us in line. Just above that risk level line that I have, right around 40. There's 40. In the last, 10 years, we've been above that level 4 times. 5, I guess, if you count the little wiki wick. So it would be a scratch lottery ticket, 100%, right? But if the world does melt, things start blowing up, that thing will do its job. But that would be the only way it'll pay you, right? So just to kind of clarify, it's not going to be a profitable call if you go out to the 40 strike anywhere along this chain, unless we honestly just get a ripping spike all the way to 40 in a single day, in a single trading session, with it just uncontrollable rip. If we don't get that, this thing will just slowly decay into nothing. It'll be worthless. So this is Facebook. And I get it. I mean, you know, It's down quite a bit from $400 in the last year. $291. It can't be right, right? 75% from the highs. PayPal. Nearly 80% from the highs. Roku. 90%. So the names you want to focus on are names that look like Apple, Tesla, Nvidia, Google a little bit. You know, I'm short in Google. These are names that have not yet had the absolutely brutal punishment that the other names have had. Now, depending on your trading style, you can wait for them to break the current low and then hop in, or you can look for a pullback before hopping in, right? And you might not get the chance, depending on how CPI goes today and how FOMC goes next week, you might not get a chance to buy it on the upswing. But everything is still making moves to the downside, right? And every time it makes a move up, it's sell the rip, not buy the dip. And I've heard some really smart people who have said, you know, Apple at 160 is something we're probably not going to see again for a decade. You know, it's very possible that we could wick into a zone like that if something really positive had happened, which didn't, but could have. But then we're looking at a long-term, you know, market decline across the board. It's an valuation reset. Earnings multiples are just so out of whack still. So something to think about for the longer swing trade plays, right? Now, you know, it's what I've talked about before constantly, that you have to learn to carry a long in a short, just like we had to learn to carry shorts in a long market, right? Like through all of this, I carried perpetual short trades. And I didn't lose money on them. I didn't really make any money because, you know, they were shorts and we didn't go down, but I didn't lose money. You have to be ready for the market to fall, holding shorts while we're going up, because you can never time the top. Well, it's the same thing with the bottom. You have to be able to carry perpetual longs even while the market continues that move to the downside, because you can't call it bottom. But how do you carry a position opposite of the market without getting just ripped apart, right? How do you carry perpetual shorts through something that looks like that? That's why options are so awesome. So when we're talking about shorting Tesla and Google and Microsoft and Apple, some of the strongest names that still have not taken the significant beatdown that they're likely going to take, it's not going to be a straight line, and it's going to be a hard trade to carry for a short play, right? Because it's going to happen in fits and starts, and every new set of lows is going to get bought up by people who think this is a really great price for some really great names that, you know, it's like, oh, it's on sale kind of logic. So both sides of the trade need to be defended right now. Your shorts have to be something that you can defend against bear market rallies, and your longs need to be defended against a continued bear market. And we can't use the VIX. Be careful today, everybody. Have a good weekend, and I will see you all Monday.